$15 billion. That's how much Canada's trade with Japan surged. A figure that doesn't just mark a milestone, it signals a transformation. This isn't just another trade statistic. It's a strategic shift that reveals how Canada is positioning itself inside Asia's most advanced economy. And it's happening while Washington quietly watches from the sidelines. Welcome to Geo Capitalist, where numbers reveal strategy. If you're new here, make sure to subscribe right now. Every week, we break down the global deals, markets, and supply chains that shape your future. And your support helps us stay sponsor-free, focused only on the facts. Japan isn't just any partner. It's the world's third-largest economy, a country investing billions into the clean energy transition and critical minerals supply chains. For Canada, securing $15 billion in trade with Tokyo means far more than exports. It means entry into Asia's economic core. Think about what's inside that number: minerals, energy, agri-food, and technology. Sectors that don't just move goods, they move entire industries. When Canadian nickel, cobalt, and LNG reach Japanese ports, they do more than fuel factories. They anchor long-term alliances. And here's where it gets even more interesting. The United States remains Japan's traditional partner. But this surge shows that Ottawa is stepping into a role Washington once took for granted. The ripple effect isn't just economic, it's geopolitical. So how did Canada pull this off? And what does a $15 billion trade surge really mean for Asia's future? Let's break it down. To understand why this $15 billion surge matters, we need to look at what's actually flowing between Canada and Japan. On the surface, it looks like a trade balance sheet. But in reality, it's a window into how both economies are hedging against global uncertainty. For Canada, the breakout sectors are energy, minerals, and agri-food. Liquefied natural gas shipments, critical minerals like nickel and cobalt, and steady exports of wheat and pork are climbing. For Japan, these aren't just purchases, they're lifelines. Japan imports more than 90% of its energy and relies heavily on stable supply partners. Every Canadian shipment reduces Tokyo's vulnerability to bottlenecks in the South China Sea or overdependence on a single supplier like China. On the flip side, Canada imports Japanese machinery, cars, and technology. Think Toyota hybrids, Hitachi equipment, and advanced robotics. These aren't just consumer goods. They're inputs into Canada's own industrial modernization. That means this trade flow is two-way resilience. Each side getting what it needs most. Each side reinforcing the other's industrial base. This isn't a one-off spike. Ottawa and Tokyo have been deepening ties with formal frameworks. The Canada-Japan Economic Partnership Agreement under the CPTPP opened the door, and new memoranda of cooperation on critical minerals and batteries are locking in supply for the future. $15 billion is the headline today. But the real story is about predictability. Trade between Ottawa and Tokyo is becoming less about price and more about reliability. That's a value proposition money alone can't measure. And one reason this relationship is turning heads in Washington. Critical minerals are the backbone of the modern energy transition, and this is where the Canada-Japan story gets concrete. Nickel, cobalt, lithium, graphite, these are not abstract commodities. They are the essential building blocks for batteries, fuel cells, and the manufacturing lines that will power the next generation of transport and industry. Japan's automakers and tech firms need stable access to these resources. Canada has them. Recent official data shows Canada's exports to Japan hovering around $15 to $15.8 billion in the most recent full-year reporting. That figure includes a significant share of minerals and energy-related products. And while 2025's annual totals are not yet finalized, monthly trade data, for example, June 2025 reporting over $1.6 billion in exports, confirms that the momentum continues. This is not speculation, it's trend confirmation. In practice, Japanese companies are moving away from spot market purchases and toward long-term security. They want supply contracts, shared standards for processing, and joint ventures that bring refining closer to the end markets. For Canada, this represents an opportunity to capture more value at home. It's no longer just about mining raw ore. It's about developing processing plants, refining facilities, and battery precursor factories on Canadian soil. And here's the thing. Every time Canada adds processing capacity, it multiplies the economic effect. More jobs, stronger wages, and new industrial clusters emerge. That's how raw resources turn into industrial ecosystems. Coming up next, we'll explore how energy, particularly LNG and hydrogen, ties directly into this surge, and why Japan sees Canada as more than just a supplier. Energy remains at the center of the Canada-Japan trade relationship, especially liquefied natural gas, LNG, and hydrogen feedstocks. Japan imports more than 90% of its energy. As Tokyo pushes toward decarbonization, its priorities are shifting, not just securing volumes, but ensuring reliability and lowering the carbon intensity of every shipment. That's where Canada steps in. Canada has vast reserves of natural gas, and new projects on the West Coast are designed to export LNG directly to Asia. Add to that a growing pipeline of hydrogen and carbon capture initiatives, and suddenly Canada offers something Japan values deeply: a trusted, low-risk energy partner with long-term potential. The numbers tell the story. The $15.8 billion in recent annual exports to Japan isn't just about minerals or food. Energy shipments are a consistent pillar, and the latest monthly trade data, such as June 2025 with over $1.6 billion in exports, confirms that demand is not only steady, but also diversified. Japanese buyers are locking in supply corridors they can depend on, even in times of global uncertainty. For Canadian exporters, the challenge and the opportunity is to move further up the value chain. That means building liquefaction facilities, expanding port infrastructure, and providing emissions verification. Japanese companies aren't just buying molecules. They're buying reliability, certification, and trust. When Canada proves it can deliver cleaner, stable energy at scale, it doesn't just sell fuel. It earns a seat at the table in shaping Asia's long-term energy strategy. Coming up, we'll turn from pipelines and ports to people and see how this surge translates into jobs, industries, and value captured inside Canada. This is where numbers meet people. Trade growth is not only about cargo volumes and balance sheets, it's about how those flows reshape industries and communities at home. When Canadian exports shift from raw resources to integrated supply chains, the benefits multiply. More factories, more skilled jobs, and stronger regional economies. Japan's demand for long-term stability is opening the door for industrial partnerships on Canadian soil. Battery precursor plants, refining facilities, and even joint research and development centers are now on the table. Every time a Japanese buyer commits to multi-year offtake, it sparks domestic investment in processing plants, logistics hubs, and workforce training. That means contracts for local suppliers, apprenticeships for young workers, and payroll that circulates through Canadian communities. Policy also plays a role. Provincial tax credits and federal green transition funds make it more competitive to locate processing in Canada rather than ship raw ore abroad. The result is higher value captured at home. Instead of exporting only raw materials, Canada builds entire industrial clusters that can feed back into exports of higher margin products. Independent analysis like this takes time and resources. If you value sponsor-free coverage of global deals, consider supporting Geo Capitalist on Ko-fi. Every contribution helps us stay independent and focused on the facts. Back to the story. By anchoring factories and high-tech processing domestically, Canada strengthens its bargaining power. It's no longer just a supplier. It becomes a place where technology, capital, and resources meet. That industrial foundation then fuels resilience for decades to come. Next, we'll examine how Washington views this shift, and why Canada's expanding role with Japan is impossible for the U.S. to ignore. For decades, Washington has been Japan's closest economic and security partner in the Pacific. But trade flows and industrial choices are never fixed. They shift when buyers discover alternative suppliers they can rely on. The recent surge in Canada-Japan trade doesn't signal confrontation. It signals diversification. Every new long-term contract with Canada reduces the degree of leverage the U.S. once held over Tokyo's supply decisions. That doesn't mean America loses out entirely. In fact, the U.S. often adapts to shifts like this by offering new incentives, partnerships, or trade facilitation measures to remain competitive. American firms are still deeply integrated in Asia, but Canada's role as a reliable alternative forces Washington to rethink its strategy. For Canada, this is more than just competition with its neighbor. It's also an opportunity to expand industrial capacity across North America. Many Canadian processing facilities are directly linked to U.S. manufacturing networks, feeding materials and components into American factories. In this sense, a stronger Canadian presence in Japan's supply chain can still reinforce North American resilience as a whole. What makes this moment significant is not that Canada is replacing the United States, it's that Ottawa is proving it can stand on its own terms in Asia's most important markets. For Japan, that diversification is priceless. For Canada, it's a chance to elevate its global profile without cutting ties to its largest trading partner. Up next, we'll widen the lens, looking at how Europe, China, and regional players are reacting to the Canada-Japan surge. The Canada-Japan trade surge is not going unnoticed. Across capitals, policymakers and investors are watching closely because this shift carries ripple effects far beyond Ottawa and Tokyo. In Europe, the response has been encouraging. Germany and Japan, two of the world's most advanced industrial economies, could coordinate strategies that include Canadian processing and resource supply. European firms seeking reliable partners outside singular supply chains see this as a sign that Canada is becoming a global hub for stability. For Brussels, it adds a new dimension to transatlantic cooperation. China is watching carefully for obvious reasons. Diversification away from Chinese minerals and processing means less influence for Beijing over strategic industries like batteries and clean energy. China is pragmatic. It will keep building its own supply base, but a stronger Canada-Japan corridor raises the resilience of supply chains that Beijing cannot easily disrupt. South Korea is both competitor and potential partner. Korean firms are major players in batteries and EVs, and they will view Canada's growing ties with Japan as a prompt to strengthen their own channels. A three-way dynamic between Canada, Japan, and Korea could stabilize pricing and reduce volatility in critical mineral markets. From an investor's perspective, the appeal is predictability. The $15.8 billion trade baseline, combined with monthly momentum in 2025, signals trust. And in international markets, trust often matters more than price. This isn't just about Canada selling more goods. It's about Canada being recognized globally as a stable, long-term anchor in critical supply chains. Next, we'll bring it all together with the big picture and what this trade surge really means for the decade ahead. Here's the takeaway. Canada's $15.8 billion trade surge with Japan is more than a number on a spreadsheet. It's a structural pivot, a sign that Ottawa is moving beyond its traditional role as a raw materials exporter toward becoming an integrated partner in Asia's industrial future. This shift reinforces resilience. By capturing more value at home through processing and industrial partnerships, Canada reduces its dependence on a single market and strengthens its bargaining power in global supply chains. For Japan, it guarantees a reliable partner outside of volatile regions. And for the international system, it signals that Canada is stepping into a role as a trusted anchor in the Pacific economy. For policymakers, the message is clear. Investing in processing capacity and securing long-term agreements is no longer optional. It's strategic necessity. For businesses, the opportunities stretch across energy, minerals, and advanced manufacturing. And for citizens, it means that global trade growth can translate into local jobs, wages, and industrial development. And this is GeoCapitalist, decoding Canada's $15.8 billion trade surge with Japan, where markets meet strategy. If you found this breakdown valuable, watch our next video. It connects directly to this global shift. And don't forget to subscribe. Your support helps us decode these transformations without compromise. Tell us in the comments, is Canada on its way to becoming a Pacific industrial hub, or is this surge just the first chapter of a bigger story? Either way, the world is watching. Thanks for watching Geo Capitalist, and we'll see you in the next video.